There's a saying on Wall Street that says, don't confuse brains with the bull market. And let's just say that this market has been a very easy market to be trading. It's one direction. I mean, it's easy if you're on the right side of that trade. So in today's stock market brief show, I'm issuing the big warning. I'm letting you know how difficult this environment is going to get when it changes. And I want to prepare you for that because I think that's going to be most important. I sent out a tweet of the P&L curve on my Fidelity account, one of my trading accounts, and I stated that at some point, trading in this market will become more challenging. So don't mistake what's been happening, this good fortune or luck, for actual skill. Because real skill is going to safeguard you during the unlucky times. And what we're seeing right now, if you're on the right side of the trade, you're lucky and it's good fortune. But do not confuse brains with that bull market. In today's stock market brief show, we're going to dive in deeper on various charts and get you prepared for when the market does turn. Make sure to hit that thumbs up. It's greatly appreciated. Let's get into it. All right, people. Yeah, the market's been ripping. It's been exciting. So welcome back to the channel over here. Yahoo! Pepe the Bull is out in full force. But let me tell you, there are bears that are still standing on the sidelines, the patient ones, looking at this market. And we'll look at some of these parabolic charts, just waiting and watching because they know their time to make money will eventually come. We did have Fed Bostic out today saying that the soft landing was hardly assured and expects 2 quarter-point cuts in 2024. The goal of the Fed is to get inflation down to 2%. The CRB index, which is a good gauge of inflation, commodities, right, rising, which is up 5% on the year, indicates that maybe we do have sticky inflation. If you look at where we are on the United States core inflation, we're still relatively high. Looking back 25 years, we're well off of 2%, and the last print came in at 3.9%. The previous one to that was 3.9% too. Now, if we take a look at the federal funds futures, right? The probabilities of a rate cut looks like it's going to start potentially here in June. There's about a 50% probability. But if there's no reason to cut, maybe the market's going to have to reprice this as time progresses. But right now it's pricing into December 3 rate cuts right now. Okay, now we're going into this week. We have a lot of macro data that we might get more information from that could change that. We have Fed Powell's testimony. We have JOLTS. We have, again, on Thursday, it's 2 days of the testimony. And then on Friday, we get non-farm payrolls and the unemployment rate. Now, the market's been ripping, and we also know that we've been in an inverted yield curve state, right? The 10 and 2 has been deeply inverted for quite some time now in 2022. But when things start to uninvert and we start to go through a rate cut cycle, we know that it has not actually been the greatest, right? If you date back all the way to the 80s and you look at the times that the 10-year, 3-month yield curve was inverted, right? This is our inversion right now. Look back to the left of the screen. This is a very steep inversion. You can see that when we had the rate high cycle, we started cutting, we started uninverting, we started cutting, we started uninverting, cutting, uninverting. What happened? Well, we were roughly at all-time highs, and then all of a sudden volatility really started kicking in, all right? Went up higher right over here, volatility kicked in. And right now where we're at, we're well off of uninversion, and we might hold rates here higher for longer. We don't quite know yet. But to be aware, if we do start cutting rates and we start uninverting, the history has told us, yeah, it's normal to go to all-time highs, but just be prepared for volatility around the corner. Now, today was an interesting day. Interesting day because today was rather flat. But if you look at the heat map, some of the big market cap names took some beatings. Apple was down 2.54%. That's where we closed off the lows. It was down more than 3%. Google down 2.81%. Tesla down 7.16%. It's basically a 50-50 here, about around 50 advancers, 50 decliners in the S&P 100. But there's a lot of green on the screen. So what held this market up when we saw the large market cap names kind of wither? Well, Nvidia has been on this parabolic run. And what I find interesting here is Apple is one of the largest market cap names, number 2. Number 1 is Microsoft. That was down, but rather flat. Nvidia now is number 3, not even too far off from Apple. Like, it's crazy to think that Nvidia has the possibility to overtake Apple of how fast it moved. I don't know if that's going to happen or not, but it is crazy. So if you look at these big names and you correlate them to the S&P 500, this is where it gets a little interesting. So Apple, for example, is well off on the year, right? 2024 started right here. We're down. We just hit a new low for the year today. And typically, you have a very strong correlated state between Apple. We've pointed this one out countless times. Now, I'm going to show you multiple different correlation charts, right? 180 days, 120, 90. So look down here on these charts that I'm going to share with you. What it's showing you, these little lines in the middle, that's the 0 line. So when it's above it, that means it's a positive correlation. When it's below it, it's a negative correlation. And you can see 90-day, 120, 180, we haven't even dipped into a negative correlated state, meaning that Apple on a medium term to long term, 3-month and so forth, it's been on a positive correlated state. Now they're starting to head down because the S&P 500 is diverging from the price of Apple. And you can see that here on the 15-day and 30-day correlations, they're now into negative territory. So when you think about this, if it's always really been positive, chances are when it's negative, it's going to eventually revert back to positive. So how is it going to revert back to positive? Is Apple going to start moving back up and catching up to the S&P 500? Or is the S&P 500 going to catch down and this going back into a positive state? I don't have that answer. Now, if we looked at Google, the same thing, right? You look out further, it's typically always positively correlated to the S&P 500. But if you look at the recent trade, it's starting to get negative. That's a little concerning here, seeing that the large market cap names are coming off, but the S&P 500 is at all-time highs. It hit a new all-time high today. It didn't close there, but it did hit one. Nvidia, look at this. This is one of those parabolic moves, and you see that it's in a very, very strong correlated state. Look at 90, 120, 180, and even on the 15-day and the 30-day, it's like a 1-for-1. This is the most dangerous stock in the market, right? Based off of its market cap, number 3 in the S&P 500, and its implied volatility and how much this thing actually moves on a daily basis. Just intraday coming off of the high brought in volatility into the overall markets. And this move has been a one-way ticket. There will come a time where it goes through a longer period of consolidation or pull back to some extent. We will see, but that right there can increase the difficulty, the environment's difficulty of trading the S&P 500. If you take a look at Tesla, Tesla has been a really positive correlated state, but all year this has been getting roughly hammered. So if you look 2024 and beyond, in the very near future, it's going back into a positive state because it's been kind of moving up, right? In the very, very near 15-day, 30-day, it started to turn up to positive. But all year it's been going down, and that's bringing the 90-day, 120, 180 into negatively correlated states, which is very rare, right? It doesn't happen frequently. The last time we were there was around June of, I believe that was 2022 or 2023. Okay? I believe it was 2023. Yeah, so September. So no, 2023. Yeah, 2023. So it's been a while since it's been in a, now that was the 180-day. I'd have to go back even further. The 90-day was roughly there too. And then it does, like from the shorter time frame, it's typically more positively correlated. And today, this one was down 7.16%. Now, if we take a look at how the sectors performed today, XLU, which is more of a defensive sector, started catching a bid, right? So 1.69%. So despite seeing the market hit another all-time high today, it didn't close at the high, but utilities was the top performing sector. Now, one day doesn't make a trend, but that is still noteworthy to continue to watch. Now, what is noteworthy, very noteworthy, is the move in gold. Gold is typically known as a flight to safety. So what is gold telling us right here in these last 2 trading days? It's up tremendously. We're closing at an all-time high right here. It didn't reach this all-time high, but it's definitely closing at these all-time highs, right? We were just at 2060, and we just moved up to 2120, 1.46% up today, almost 3+% in just 2 trading days, which is a gigantic move in gold. And this has been kind of putting in higher lows. It's been consolidating, and we just saw a recent big breakout on some big volume. Bitcoin, a very similar story. This has been parabolic move, reaching into the prior all-time high. I wouldn't be surprised if it hits it there in the very near future. It's probably a few $100s off at the time that I pulled this. So this is typically more of a risk-on asset. So there are confusing things, but this has once again been a one-way ticket on a risk asset. And we've seen one-way tickets before, and they consolidate. They pull back. And that's when the market can get a little bit more increasingly difficult. And you have to be careful, because if you just try to buy any and every pullback, even if your P&L curve looks like this right now, you may do something stupid that can wreck it entirely. So the main goal here is to reiterate the most important aspect of trading these markets, and that is focusing in on what we control, and that is 100% risk. Another interesting thing to look at is some of the regional banks, right? NYCB was down another 23%. So is there something bigger going on under the surface I don't know if this is just a one-off, but being down another 23% today is pretty insane. And this is one of the top 10, well, now it's probably not in the top 10 anymore, regional banks in the KRE. And the KRE has been kind of just flagging out sideways. Today it looked pretty good, but then it closed and reverted back to its low of the day, closing at roughly the low of the day. But I can't speak for all the regional banks. Like, for example, the number one regional bank in KRE is HBAN, so Huntington something, right? Huntington. And this looks like it's breaking out today of this in a positive trend. So we'll see if this continues to break out. So maybe NYCB is more of a one-off, but we won't know unless we start seeing more cracks in the surface. If we look at Dow Jones Industrial Average, this has been on a one-way ticket up with very small consolidations. Right now, I'd consider this a little consolidation, but we are seeing the negative divergences form here on both the MACD and the RSI. So as price is going higher and higher, and it could continue, the divergence in these specific indicators are telling us that the internals are weakening, which can be an early indication that we may see weakness in the near future, and we need to at least be prepared and measure and map out some key levels where we can manage our risk if the market starts turning back around. If we look at the SPX, a very similar situation. This has been on a one-way ticket up. Today has a little bit of a shooting star type candle, right? We were going up to 51.50. We missed it by a few cents, which was also a big gamma level, which I'll cover here shortly. And then we closed roughly at the lows, still have that negative divergence forming, and on the MACD as well. But overall, bullish context, right? It's bullish context. If you look at the 200-day, if you look at this breakout area, we haven't actually seen what the market looks like on an actual pullback, on a consolidation, or a 5% or 10% correction. If we take a look at the Qs, same situation. We had an inside trading day today, negative divergence that is forming on the Qs. Very similar story, how it's kind of been grinding up higher. I should note that S&P 500, if this press higher, is really tracking Nvidia's price action. We had that big gap up, pulled back a little bit, and then followed through. All right, I'll show you the chart of Nvidia and how much it matches up here momentarily. Now, these are the big index products, and they're also moving into the fear and greed index, into extreme greed territory. Extreme greed territory is not necessarily a good thing to be in because we typically can see markets pull back in the near future. Now, if I look at dating back to May 2021, you can see the blue line is when we get above the into extreme greed area. Extreme greed, I'll just put the color G or the color green right here. This is when the blue line gets above this green line, that's extreme greed. And then the red line is the S&P 500. So we got over here, we pulled back, and then we went down lower. We got over here, the market pulled back a little bit. We got over here, the market pulled back a little bit. It's when we typically cross back beneath it over here. We went through that 10% correction. This over here was like a 9% correction. And now we've been kind of trading in this area, right? We came over here, we came out a little bit. It was a little consolidation. And now we've been trading within this area too, as the market just is grinding and squeezing itself a little higher and higher as time progresses. If you take a look here, you can see like the little arrows pointing to the times that we moved into extreme greed state. Now, if I look at semiconductors, the same situation, a very parabolic rise, one-way ticket on this whole AI bubble craze, right? I guess it's not a bubble until a bubble pops, actually. So right now, the trend is up, but it's really moving into that parabola type of move, right? You can see the curvature of this move, right? It's curving up straighter and straighter and straighter like this, and the pullbacks are getting less and less and less. And these are typically where you get these blow-off type moves that go into periods of consolidation, right? We can't forecast that quite. What we can look at is implied moves as a future indicator of risk, but we can at least be made aware that, hey, if you're just trying to enter in long right here, you may squeeze out a few extra dollars, but your capital might get tied up in a month-long consolidation, a 2-month consolidation, a week consolidation, a year-long consolidation, right? Who knows, right? If you bought right here in June of 2023, I mean, you didn't really move out of it until December of that year, right? And you may have gotten out earlier if you just let it go down all this way. And then you may have tried to look to re-enter, right? So you can go through these periods where you get sideways price action. It doesn't just go straight up forever, right? Stocks typically take the stairs up and elevator down. And let me just tell you, what would the elevator look like if that was your staircase? Good question. I don't know. Now, this candle is a shooting star type candle here too as well, or a gravestone doji, or whatever you want to call it. But basically we press higher and higher, but we close basically where we opened, but still up a whopping 1.61% on the day. This is Nvidia. And what I mean by that gap up, move up higher, pull back, and then the shooting star. That right there mimics to a T the S&P 500, how we gapped up, pushed up higher. And so this is why this stock is incredibly, incredibly important here, that if we do go through a period of consolidation and we don't catch bids in some of these other large market cap names, such as Apple and Google, which have been getting hit, that is not a good sign for the market. And that's where it's going to get, once again, much more difficult. And this is why I'm sending out these warnings right now to be made aware if it does take place, right? So that was Nvidia. SMCI, right? This one doesn't have weight, but it is going into the S&P 500. We'll see how it's weighted. But also, once again, right, people over here talked about how perfect they shorted it. I guarantee you people were all over trying to short this today, thinking that we'd get a huge reversal and probably got their faces ripped off. But this put in a new all-time high today. And this is what happens during parabolic blow-offs phase. You get these big moves and people think, oh, yeah, that's the top. And what do we say? Like, I wouldn't be surprised for this thing to fire right back up to the upside, because shorting these type of things for longer term is incredibly difficult to short these type of names because of the trend, the momentum behind it. It's just something that I would refrain from doing unless if you have very specific risk and levels mapped out and you're really focused in on that position sizing. But those aren't the only names. We can take a look at retail. Look at Abercrombie and Fitch. Tell me this doesn't look like a parabolic kind of move, right? It's kind of slowly kind of moving up, grinding, right? Nice bases right here, nice base breakouts, nice base breakout. But you'll notice that the bases get shorter and shorter and shorter, and the rise tends to be more aggressive and more aggressive. And this is what a parabolic move looks like. And parabolic moves can end not necessarily always in a disaster, but they can blow off, and you might not see that high for a very, very long time later. Now, I don't know how high these are going to go, but I'm just showing you the curvature of this right now, because just look at how crazy this is going. And these can squeeze up higher. Don't get me wrong. I'll show you an example of a stock that squeezed up a lot higher. Okay, look at Costco. Now, I'm showing you Costco because Costco is also a big retailer, and this has been on a one-way ticket. And the real reason why I'm showing you this is because if you just look at where we were in October, I mean, we were over here at 540, and on my live trading session today, so 540 to we'll just say 740. That's 200. It's technically more than 200 points. We'll say $250 up higher per share in 1 month, 2 month, 3 month, and 4 months. 4 months, it moves 240 points. Now, want to know how crazy this is? If you go to the options chain right now, look at the expected move of how far you have to go out to see a plus or minus $240 move. You'll have to go out to 2026, January of 2026, just to see a $200 expected move. Meaning that what we just did here in 4 months typically can take 2 years to occur in a name like this. This is right? So the point here that I'm telling you is these are once in a lifetime type rallies taking place, and they could continue, but when they turn around or they consolidate, be prepared for that. Because if you're not, you can get caught off guard and you can lose all the gains that you've accumulated, especially if you get aggressive. Walmart's another one. Walmart's trading like a meme stock, like a large market cap name, right? In December, we were down here at 50. Well, I know, right, for the 3-for-1 split, but it's up $10 in a few months' time. And a $10 move in a stock like this also takes about a year, typically around a year, right? That's crazy to me. And it happened within a very, very short period of time. Look at the financial sector. Financial sector can take multiple years for a move like this to occur. 31 to 40. What's driving this? Who knows? Who really knows? Like, why is the market moving quite so parabolic? This is melt up, parabolic moves, insane type of price action, and it brings in a lot of FOMO. If you caught the move, it brings in potentially a lot of greed, a lot of like probably you want to brag. You're like, yeah, I'm doing so good. But the unfortunate thing is a lot of the times, if you're FOMOing into strong moves, you can catch it for a little bit more. But then if you did FOMO, you're hoping that it goes up higher. and higher and higher, and you may hold on to a bag. And if you did trade it, you may end up be a position where like, dang, I should have put in more. I should have put in more. I'm going to buy more on the pullback. I'm going to buy more on the pullback. And that's where it gets a little dangerous. You start thinking about how much you can make, and you completely forget about how to manage your risk and being thankful for the moves that already came in the market. Now, when I said like how squeezes can get crazier, right? We talked about Abercrombie and Fitch of how this looks like it's just moving into the blow off of blow-offs. Take a look at MicroStrategy, right? Now, this is a higher short interest name, and it's moving with the price of Bitcoin, but just look at this, like, right? Just in February, we're down here at 450, and we're at the beginning of March, and we're at 1350. These are very rare occurrences in the overall market. And it's fun and games, especially if you're on the right side, or if you're not even involved, like it's fun and you can make some good money. But if you're on the wrong side, or if you get too greedy, once again, that is the warning here that I want to kind of lay over on this stock market brief show, because if you were fortunate enough to catch some good gains, once again, don't confuse that as like you're smart, like you have a lot of skill. I know that might hurt some egos, but the reality is this has been a one-way market. You haven't been, right? If you caught this move, like I'm telling you this from the perspective of my P&L curve. I was basically pretty chill throughout all of 2023. When the opportunity came in October, I went super duper hard, and I blew this out. I blew it out completely, just ripped it to shreds. I didn't even care that I missed half of the year or most of the year, the prior month on this specific account, because I made up for all of it and some, okay? But I'm not confusing this as skill. I'm just considering this as I got very lucky that the market kept going up and my positions kept going up. That's the reality of this situation right here, okay? Now, let's continue on. I hear Coco barking in the background. So we talked about Walmart, we talked about financials, and then MicroStrategy. Now, I'm going to go into the S&P 500, look at the weekly expected move, right? So today we close off a little bit of the low, but we do have macro data coming out. So as far as the weekly expected moves, 5073 to the downside, 5200 to the upside. 5200 is going to be an important one to watch, especially from a gamma perspective. Now, I want to show you the monthly expected move for the SPX. The monthly expected move, meaning this is what the market's pricing as far as risk for the month of March, which happens to be at the end of quarter, right? So this is the last month of the quarter too as well. So 52.46 to the upside, 49.46 to the downside. So even if we come down to the lower move, maybe perhaps that opens a possibility where we can play another bounce to the upside. Because if the market, like highly unprobability that this is the top, right? That, oh yeah, now the market's going to completely collapse, right? You might have thought that here. You might have thought that here. You may have thought that here on this big gap down, and you would have been wrong every single time, right? The trend right now is up, right? So you look for pullbacks to buy because this is momentum. These are momentum. This is all momentum right here. So until something dramatically changes, which will get more tactical on the smaller time frames, the trend still remains up. Okay, so you look for dips to potentially buy up until the point where I will go into here when we look at the gamma chart. So if you break it down into the 15-minute time frame, you see the weekly move on the SPY, 506 to the downside, 519 to the upside. You have a daily expected move going into tomorrow. Tomorrow should be somewhat calm. I can't guarantee that, but the expected move is rather small as we're pulling into the month to date, which is the March anchored VWAP. The February anchored VWAP's way down here. I mean, we're still above a rising 5-day moving average. Now, tomorrow we don't have too big of data coming out. We have data coming out, but it's really Wednesday, Thursday, and Friday that is going to be the bigger impact potentially, or at least can hold the more potential for volatility, because we have Jerome Powell and we have a jobs data that tends to be incredibly important for these markets. It's a tier 1 type of economic report coming out that the market sees that way, okay? So overall, 5-day moving average is still trending up. So if we break down from the 5-day moving average, you get bearish, but with caution, right? Like right here is bearish, but with caution. Why? Because it's still trending up. Okay, it was still trending up, so we gapped right up. Oh, we got below it. Okay, bearish. It's flat, but bearish with caution. Boom, we move right up. The last video, we talked about how we had this very kind of algorithmic move to the downside. Then we compressed, and I said, don't be surprised to see this thing break up and just rip to the upside or break down, right? But most likely be more bullish because of the context of the chart and how it was set up, being that we were still in that positive gamma territory. Speaking of gamma territory, 5070 is now the flip line as it stands currently. We're in positive gamma territory, so that means you look for dips to potentially buy. We're above a rising 5-day moving average, which is positive. Today, we hit a very important level at 5150. Now, this was all day we were looking at this level. We basically said, because we look at 0-day range, so if you see me on a live stream, come join in, you'll hear these. But we basically looked at 5150 to 5155, and then to the downside, it was 5110 to 5100, or 5115, I believe it was, something like that. But we basically said it was probably going to trade within the zone and potentially tag one of these. And it came into this level, which happened to be a big 0-date level. They got paid, they got out. And a 5150 is a net gamma level too. So going into tomorrow, this will be an important level to watch. If the market wants to press higher, 5200 now, traders are starting to roll out further, right, to the larger strike. So 5200 is starting to grow. 5100 was the key level, and that could still come into play. We're not far off of it, but remember, we talked about how we can get above it, and it's going to be hard to break away from that if they don't start reaching up higher. Well, now we're slightly above it here, but don't be shocked if we start pulling back into these levels. If Nvidia comes off, if Apple can't catch a bid, if Google can't catch a bid, Microsoft and so forth, it's very likely to come back in. But Nvidia so far, as it stands, is driving this market. So once again, I want to reiterate that this is just a warning that market conditions do change. When they change, how do we look at it? Short term, go into negative gamma territory, the market conditions are going to change. When we're below a 5-day moving average and it's starting to decline, that condition is going to change. Till then, the bull stands strong. But when it changes, be prepared and do not confuse, once again, that good fortune that's been taking place for skill, right? It is not skill. Skill is going to protect you during the unlucky times, and that's when the market conditions change. That's all I got for you on today's episode, everybody. Hope it helps out. See you later.